You're watching us here on Trading Hour. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangala Malu. With me, as always, Ritu Singh joining in. Ritu, good morning. It's been a tough morning for bulls, just the way it was all of last week, where you saw sell-off in the first half of trade. Thereafter, either stayed around at those levels or maybe decelerated in the second half of trade, and that paired with the rupee weakening. All these factors happening, and right now, as we speak, the Nifty opened lower, thereafter saw a recovery. That recovery was sold into currently below that 25,000 mark. And interestingly, to add, spice to the latter half of trade today, we have the January series expiry as well. And we've lost, 950 points and counting in the January series.
Well, lots of triggers, Mangalam, for the markets today. And of course, the big EU trade deal, that is one of the big macro cues we'll be watching out for. But yes, the market breadth very much in favor of advances as we speak. It's about 1,900 stocks that are declining for every 950 odd stocks that are advancing. That's where we stand right now. The Sensex down 280 points as we start the trading hour at 11 a.m. today. The Nifty down about 58 points. What we're seeing in terms of sectoral performance, again, some of the banking-packed names have been in focus on the back of earnings. In terms of the top gainers, if you look at them, Karur Vysya Bank, that stock is quite up and about 9.9% up as we speak. Home First Finance, Axis Bank is up about 5.3% as we speak. But on the flip side, you have some other names that are declining. Syngene, JSW Energy, Godrej Consumer, you guys were speaking about. So lots of individual names that we'll have to focus on today. We're bang in the middle of earnings. A lot of big banks have already reported. Many more to go through this week. But let's kick it off with some action on, the energy front, where JSW Energy reported its third quarter earnings. Vivek is standing by to decode those for us. Vivek.
Well, that's right. Slightly muted quarter along expected lines as far as JSW Energy is concerned. Remember, power companies this time have been faced with what is essentially an aberration in terms of power demand. FY26 power demand has been quite muted. In terms of the numbers themselves, revenues higher by over 67% on the back of the fact that the company had significant M&A activity, and on the back of the higher asset base, you did see revenues go up significantly. EBITDA more than doubling, margins at 49.8%. But on the back of those very M&As that the company has done, the interest costs surge higher. And if it wasn't for a tax write-back of close to 750 crore, the company on the bottom line actually slipped into a loss, and that is something that the street didn't like. In terms of what brokerages had to say, CLSA says that the results shock as it slipped into a loss at the PBT level. Impact from higher funding costs from leveraged M&As and weak power demand weighed in on the results. The core parent third quarter numbers were quite weak, and in fact, PAT was down almost 60%. The valuations, according to CLSA, are quite expensive. 24 times price to earnings 1 year forward, and 2.7 times price to book 1 year forward as well. In terms of Morgan Stanley, they're saying that they expect RE commissioning timelines to be pushed out further. They've cut the target price quite sharply, and they also assign low valuation multiples to the RE portfolio due to the increased costs across the solar supply chain.
All right, Vivek, thanks a lot for that. The market flitting between 25,000, a little over that and under that right now, though a lot of individual stocks are taking it on the chin, and how IFB Industries down 15%, JSW Energy that Vivek just spoke about down 8%, Sun TV is down about 7% as well. Signature Global, ever since the company has announced that demand has not kept up with what the company's own expectations were, the stock has actually corrected almost 40% from its 52-week high. But amidst all of this, one stock which is still holding with relatively benign cuts is Urban Company, down just about 1.5%, because maybe the street thinks that this is a bottoming out quarter for the company. Why do I say that? Because from the peak, the stock has already nearly halved, from over 200 rupees to about 125. The revenue up 32% year on year. The EBITDA loss, yes, it increased to about 35 crores, but the company says ex-Insta Help, the EBITDA has actually come at 44 crores, which is a good positive, and it's about 4.2% margin of net transaction value. But let's go across to Ritu. Ritu, it's all about earnings, and we have Shriram Finance as well.
That's right. It was quite the steady quarter for Shriram Finance. Good all-around improvement in margins, improvement in asset quality. So, that has been a stock in focus on back of the very large FDI deal. In fact, the largest ever in the financial space that was announced in December as well. We have Umesh Revankar, the Executive Vice Chairman of Shriram Finance, joining us now to decode the numbers of the quarter gone by and give us a view on what the way forward looks like. Mr. Revankar, always a pleasure to have you here. Let's start with the numbers before we get to the MUFG deal and its advancement. Your AUM growth of about 14.6% year on year. It is growing in line with what you had indicated. You've given us a target of, I think, when we earlier spoke, 18 to 20% for the next financial year. How do you expect to close the year to begin with, given some of the contraction that we're continuing to see in the CE business and the MSME business as well? There, the AUM has just barely grown by about 1%. Are you seeing any sort of weakness there? And how do you expect to close the year to begin with?
Yeah, good morning. By and large, I feel it is a very good quarter because we did anticipate a certain slowdown in certain segments, but the commercial vehicle and passenger vehicle have grown very strongly, and that really helped us. As far as the construction equipment is concerned, the infrastructure activity in the last 1 year had slowed down. So therefore, there is a less offtake of construction equipment, and that is really slowed down for us. But we believe post-budget, things will become much better. There will be higher demand coming because people are looking for a long-term understanding of the infra spend. And I think budget will be a strong indicator for that. As far as SME and MSME is concerned, we did had slowed down a little in certain segments because some of the MSME were dependent on US market, and because of the tariff uncertainty, the slowdown is there in the credit offtake. I believe that also would get addressed because many of the MSME segments, the customers whom we discuss, they are looking into newer market, and markets are looking promising. As and when they are finding new markets stabilize, I think the credit offtake will improve.
When you speak about the budget and some improvement on your construction equipment portfolio on account of some of the announcement in infrastructure, could you detail what exactly you'd be watching out for and how much of an improvement can we see in FY27 over the kind of performance that we see in an FY26, especially as this large money also flows in that is sure to boost some of your growth for the business?
The infrastructure spend by the government will have a multiple positive impact for us, not only in the construction equipment, but also in the heavy commercial vehicle, because heavy commercial vehicle is mostly dependent on large transportation like cement and steel. Even though cement and steel manufacturing production is not come down significantly, there is a good demand from the other segment like real estate. But the large infrastructure project will give a large momentum for the demand. And many of these heavy commercial operators, they do buy new vehicles during February, March for their own year-ending purpose. I believe that a good outlay for infrastructure in the budget will be very positive for us as far as the demand for heavy commercial vehicle and also for the construction equipment sector.
So just briefly again, to come back to your AUM, I think 80% of your AUM now is from the wheels business, and within which 97% is from used vehicles, only about 3% from new vehicles. As you redraw your plan for FY27, is new vehicles an area you'd focus more on? Are there any other newer segments as well that you're looking for, as you redraw your strategy with a new investor on board, with a new financial year starting as well?
See, our new vehicles portfolio is around 10%. We would like to grow it to around 15% because there is enough opportunity for us. Many of our customers who remain with us for 10 to 15 years then move to the competition or to the bank want to upgrade themselves to buy a new vehicle, because new vehicle is a higher ticket size. And when they buy an asset of higher ticket size, they would like to have a competitive rates. And we would like to retain those customers. because we have a very large number of customers, and if you are able to retain our customers, that itself will give boost to our AUM to around 18%, because we have targeted to grow from 15% AUM to 18% in the next couple of financial years.
Right, Mr. Ivankar, now let's get talking a few numbers. Just wanted to understand if you could give us these on a quick fire basis. 18 to 20% AUM growth target for FY 26 and 27 intact?
Yes.
All right. Any outlook on credit cost? It's come down to about 1.8%. How much lower does it go from here?
See, as we do more and more new vehicle, the credit cost should improve. We believe that around 10 to 15 basis point improvement in the next couple of years is a possibility. That's where we are focusing on. But since our overall business is retail, there will be some ups and downs. So
right.
We would like to be conservative on the estimation.
FY 27, can we see an ROA upwards of 3.5%?
Definitely, yes. With the capital coming in, there will be a significant improvement in the ROA. And that will keep improving for maybe 1.5 years. That's what our estimation is.
You did speak about the capital. I wanted to understand, what your strategy with that additional capital is. How much will you plow back into growth, and how much will you do that to disrupt the market as well, which is a little worried about you suddenly having a lot of money. So I'll let you answer that. But before that, gold. I mean, that's doing extremely well for a lot of these gold financiers. You aren't part of that, or you aren't growing as much in the gold finance space. Is that strategic, or what explains this? Are you looking to build some aggression out here as well?
Yeah, definitely, yes. In the gold, we do have a plan because we have a large customer base. Typically, people who would like to borrow against the gold would like to go to a trusted place, a trusted brand, a trusted people. So we believe that a lot of our customers hitherto have been moving to other financial for loan against gold. Will come back to us once we have a proper infrastructure in place. We have added some branches this quarter. Every branch quarter, we are going to add more branches for gold financing. And once we are able to do that and communicate to the customers, we'll be able to build large gold portfolio without really going out of the way to do gold financing in a big way. Our existing customer itself will be able to double the portfolio in 3 years.
Okay, got that, sir. It's a quick word on the MUFG deal closure. I think last we'd spoken, you had given us a tentative guideline of around, March is when you're looking to close that. Is that on track? And secondly, also, in terms of rating upgrades that were long awaited, we've already seen two. I think one provisional, one is coming as well. To what extent do you expect your cost of funds to improve from here? And your long-term NIM guidance, I think, from 8.5% to almost 10%. How quickly do you think you could get there?
See, basically, the rating upgrade is coming in. And before rating upgrade getting announced, if you look at our borrowing cost, incremental borrowing cost, last quarter it was 7.73 against 8.12 in the previous quarter. So that means there is an improvement of nearly 40 basis points Q on Q for us. That will further improve as the rating upgrade get announced and the impact of that comes in. So maybe not this financial year, next financial year we will have more positive impact of the credit rating upgrade and the incremental borrowing cost. In the book also, the borrowing cost has come down from 8.83 to 8.69. So overall book also will get changed by next financial year. So these are the two very positive things which will happen. The net interest margin has improved from to around 8.58 now, and I believe it will improve further. We have given a long-term guidance of 8.5 to 9 because some of the benefit which will come to us will be passed on to the customer, especially to retain the customer for buying new vehicle. So there will be some range-bound situation as far as the net interest margin is concerned. And benefiting the customer also is one of the part of it.
So the MUFG deal closure timeline, that was the other question.
It should be by financial year end. That's the estimation. And the process is on. Application to the regulator and the CCI is in the process. And once probably we'll get approval, then we should be close it by the financial year end.
All right. Mr. Ivankar, you did say that incremental savings on cost of funds will be deployed back into growth, be passed on to customers. And that exactly was the question. With a lot more capital coming at your disposal right now, with a lot of scale, the fear is that you may disrupt the industry by growing a lot faster, or maybe, giving loans at a price which will be a lot more attractive as against competitors. So this 8.5% to 9% NIM guidance stays. But how much will your loan growth be faster by, over and above what you already do?
See, we don't really intend to disrupt the business by lowering the rate or by being very competitive in the market. We would like to retain the customer who are moving out. So that itself is sufficient for me to grow at around 20% AUM. So I don't have to really go and get the customer from the other competition to us. So that's not the plan we have.
All right, take that point. Thank you so much. Good luck on the deal and the numbers as well going forward. Wish you all the best. 20% plus growth, improvement in credit cost, improvement in NIMs, and overall improvement in ROA as well. 3.5% for the next financial year. We take a short break, come back. We have another financial company joining us. Karur Vysya Bank joins us on their third quarter earnings.
Welcome back. We'll continue with our focus on earnings, and one stock that is up and about today, in fact, one of the top gainers in Nifty, today in trade is Karur Vysya Bank, up more than 10% on the back of an exceptional third quarter numbers that the bank has reported. When we have B. Ramesh Babu, the MD and CEO of Karur Vysya Bank, joining in now. Mr. Babu, thanks very much for your time here. I mean, let me start with the third quarter numbers. Pretty impressive, especially what you've done in terms of margin growth. I think it's one of the highest among the banks that have reported their third quarter numbers so far. What next from here on? Can you better this performance? Let's start with the margins in the fourth quarter, especially as, the next policy comes out. Perhaps the street is factoring in at least one more rate cut from RBI. Do you have levers to improve this performance from here on, starting with the margins?
Yeah, good morning, Ms. Shrita. Thank you very much for the call. In fact, before I talk about, luckily, we could tick all the boxes this quarter. And above all, three parameters which we continuously monitor is growth, profitability, and asset quality all have worked well. And above all, December 20, the quarter profit was 35 crore. And this quarter, it is 10 crore short of 700. So that way, in the last 5 years, the profit has grown by 20 times. And 2022 also, if you look at our annual profit was 673 crores. And this time the quarter profit is 690 crores. So that way, the many other things what we have planned started working. So that way we are able to do. Now, if you look at the margins also, it is not only on account of a cost of deposits coming down or yield slightly going up. Multiple factors have supported us. So agreed. 16 basis points, we have got the benefit out of the cost of funds, and 6 basis points on the yield on funds also have gone up. But operating cost also has come down, credit cost has come down, because there is no room for providing now. We are at such a stage now, because net NPA is at 0.19%. It is one of the lowest that way. And above all, SMA numbers also, if you look at it, it is 0.24%. So that way, we have a perfect control on the future cost, credit cost also. With all these things, if you look at it, the margins, I won't say it will improve. The reasons are simple. Because Q3, we had the benefit of many of the deposits, time deposits got repriced. So that benefit, it may not be there in the Q4. Okay. And above all, few of the low cost deposits may get repriced in this. So that way it may be flat, but the yields are concerned. We have done something. Few of the loans we have shifted to fixed rate loans. That has helped us, which used to be around 8% at a point of time, fixed rate loans. Now it has moved to 23%. It may further go up. By the end of the Q4, it may reach 26, 27% also. That may keep us afloat despite the rate cut in the December also. So we have given a guidance that we will be able to maintain our ROA of 1.85. Initially, we were saying it will be between 1.55, 1.65, those sort of range and all. So with the confidence what we have got that many of the things what we are doing are working, we gave an indication of 1.85 for the whole year.
All right, Mr. Babu, take that point. I remember you earlier saying that you expected NIMs to be between 3.8 to 3.85. Now you've upped the guidance on that as well. You said if the rate cut could come, it would be around 3.95, and you're closer to 4 right now. So I wanted your thoughts on that one, and also 1.85 ROA. We will take that. Also, congratulate on the board giving you an extension for 2 years. Now it's the RBI which will go ahead and have to do that. But I remember from that conversation, two things stood out. One, you said that RAM has grown upwards of 20%, and you expect to maintain that 17-18% sort of growth rate on that portfolio. Has that happened? And the second part, corporate book, which is 16%, which was at that point 16-17% of your assets, you wanted that to go back to between 20 to 25%. So on both those parts of your book, if you could give us a sense.
Yeah. First thing is I'll talk about the corporate book. It's not the question of either corporate or RAM, because you know very well the deposits, it is slightly scarce and you need to pay some cost on that. Wherever we get the better yields within our risk appetite and where the safety of the funds are also there, we will put the money there. So that is the reason what we thought in the RAM segment also. You can look at it, suppose under the retail segment, we are not doing well in the home loans as well as vehicle loans because the pricing what we are getting is very low there. So there we are growing in the gold loans as well as the LAP there. Likewise, commercial, which is yielding well, we have gone there. Agriculture also, the majority of the gold loans what we are getting, we have got it. So our focus mainly is on the yield rather than the segment. So whereas corporate is concerned, earlier we were not growing, but this quarter you could see around 6% growth. The reason is we have identified few sectors like CRE, like ECL contractors, whatever are there. Few other areas we have found out where the pricing what we wanted, we have got it. Overall corporate portfolio yield also it is 9.2, 9.3. Earlier it used to be below 9. So that way we will look at the first of all deposit cost, not the question of 17, 18, 20% on the RAM. What all deposits we can raise reasonably good. So based on that we will plan for our advances growth and all. So preference will be given to the RAM. I don't think saying that this 14% of the corporate will move to 20% in the near future because lot of potential which we need to exploit under the RAM segment is still there. We will try to get that because we have more or less mastered the risk management in that, the onboarding, guardrails, monitoring with all these things. It is better we put our money there. If we exhaust our opportunities, then we'll move to the corporate.
Okay, so the focus will very much remain on retail, agri, MSME. But Issa, specifically on gold loan that you briefly mentioned, it's now almost a third of Karur Vysya's book. How much more do you think you want to grow it? What kind of opportunity do you see? And in terms of pricing as well, what kind of competition are you seeing in the market? Because we've seen a whole host of financiers step up the game as far as gold loans is concerned.
I know. But if you look at Ritu, last 5 years, more or less our gold loan book, though it has been growing, it is below 30%. So internally we thought saying that every product also need to have a cap. That's why gold loan portfolio will be below 35%, irrespective of the vertical it belongs to. Even now also, if you look at it, it's below that number. So that way we are mindful of the fact that no product should overtake and overall the bank should not become a product specific bank. So next, coming to the competition is concerned, I know very well the competition is there, but gold loan is such a product where the customer connect and the TAT and the how faster you are able to give them hassle-free, that makes sense. So we have the expertise. In 1916, when the bank started with the gold loan business. So that way, the gold loan is the DNA of the bank that way. So we don't have many delinquencies also there also. So that is the reason many of the branches, they do that. And in fact, few of the branches, what we do now, where the potential is there, we have created infrastructure for the gold loans, wherein the TAT can further improve. So that way we feel that we are in a measured way going. The 35% when we feel, we look at it, what pricing we are getting and all, accordingly we'll plan.
Right. A quick question, and if you could answer all the three parts, that would be great. One is on your credit card. You said that you are starting that business and you're taking their steps once again. So how big do you expect that to be? Second, you are looking to increase your revenue coming in from non-fund sources, which includes the like of bank assurance, etc. How big will that be? And third, the stock's done well. Business is all good. Are you looking to raise capital?
Yeah. So first 2 points, Mangalam, in fact, we are left with a quarter. So let us size up what we are doing during this quarter. When we come with the March numbers, we will give an absolute guidance on respect to the credit cards as well as non-fund also. But because we are in a baby steps we have taken in these two, and credit card particularly some sort of a people also we have taken, they are yet to stabilize. This quarter, if we see the stabilization, we will have a clarity by the end of the March. We will be able to disclose along with our March results. The same is the case with non-fund based, because we could see some sort of a traction in few outfits. The challenge for the banks is how to get the traction in the rest of the outfits, which we are very confident in the next year to do that. Coming to the capital is concerned, you would have already observed that our capital adequacy is around 17%, and without plowing back the profit of this year. If you plow back the profit at the end of March, it will be 18%. So having more than the required capital also is not warranted. It may tempt you to take undue risk, which may pain you later. Currently, if you have seen that our unsecured book is below 2%. There itself, we have some scope to go up to 5%. With all these things, I feel that next 2 years, there is no requirement for the bank to raise the capital the way which we are earning the profits.
Got it. So no requirement for capital raise in the next 2 years. Finally, Mr. Babu, very briefly, run out of time. Slippages, especially in the retail segment, some of the lenders we've been speaking to have indicated mixed trends. Some are saying in the MSME, the stress is peak. Some are saying it may take another couple of quarters. What are you seeing on the ground? And, any guidance you could give us as to where you could close the year?
Yeah, in fact, MSME growth, initially the guidance given by us is 2% over the industry. So what we feel is MSME can be around 15-16% annual growth. Really, the only point is we can grow abnormally. The point is the pricing is the key. There's a lot of competition in the market for the pricing. So wherever it is not making sense for us, it's not fitting into our scheme of things, we are leaving many of the accounts there, because in a particular locality, if I reduce a rock and give a rock bottom pricing, 20-30 people we may have to give that rate. So which is unfair. So that is the reason few of the accounts we are exiting consciously. This is the right time when there's a lot of demand in the market. The weaker accounts, you need to get out of that. If you do all the math finally, otherwise you can grow at 20% consciously, it's not a big problem. But we thought with all these things, simultaneously cleaning up and growing safely and getting the proper yield, all these three pillars, if you take care of that, growing at 16% in MSME should not be a problem.
All right, take that point. Mr. Babu, thanks very much for giving us all of those details and an insight into what's next in the next quarter. And we hope to have you back here to discuss those going ahead. Thanks very much for your time. We have to slip into a short break, but when we return, we're going to discuss market technicals with Rajesh Palvia. Stay tuned for that.
Welcome back. You're watching us here on Trading Hour, and it's been so volatile so far. If you look at the intraday chart of the Nifty, you would see that, it opened lower, thereafter went back into the green, tested higher ranges, then went lower, now back into the green, up as well, up around 20 points, closer to that 25,100 mark. At one point when we started the show, it was fighting for that 25,000 mark itself. And that's what's reflected in the broader indices as well. So if you look at, the Jan series expiry right now, and that's the perfect time to get you all the updates from the F&O desk. The mid-cap index is marginally in the red. The Nifty bank has been outperforming, especially on account of a couple of these large private sector results. And the India VIX has seen a big spike ahead of the budget, ahead of important events, ahead of expiry. And after the sort of volatility that we've seen in the market, it's understandable that the India VIX at one point, which was sub 10 sometime last week, has now rallied all the way up to closer to 15. All of this at a time when the rupee is still stable. Remember, we saw a big gash on the rupee in Friday's trading session, the second half particularly. Now it's holding around that 91.8 mark. Let's see where it goes once, the European markets start, once the US markets also, as we move towards the end of trade today. And we've gotten a nice range now for the frontline index. Today's low on the Nifty corresponds very well to the Jan 1 low. 24,920 was the Jan 21 low, after which the Nifty saw a massive recovery. And today's low, 24,932. But on the way up, the 200-day moving average is a bit of a hindrance. Why do I say that? Because today's high as well couldn't sustain a little above the 200-day moving average of 25,143. Today's high, 25,185. And that's exactly what the option writers are expecting as well. The 25,000 put, very active in trade today, 40 rupees on premium, 2.5 crore shares outstanding, telling you 24,950 or closer to today's low is where the support comes in. But as we move towards today's high, which is closer to 25,200, that's where supply comes in as well, and which is why call writers at 25,200 very active here too, nearly 2.5 crore shares, premium of 20 rupees. So the broad range for the Nifty today, 24,950 to 25,220. But then all the action after today's expiry moves into the Feb series, and that's where a lot of triggers left. You have the union budget, thereafter the RBI policy, remainder of the third quarter earnings, and any sort of update coming in on the trade deal. We've been speaking about India-EU deal, but does that happen with India-US as well or not? Will be important triggers to track as we move along. But with that, we'll take a short break. And as we do that, we do have Rajesh Palvia joining in for the technical check on the market. Rajesh, what have you made of the moves so far? It's been fairly volatile, choppy. Do you think it's better to be stock specific rather than track a trend on the Nifty?
Yeah, so looking at the choppiness in the market, yes, it's very difficult to trade in the Nifty as well as in the indices because the Nifty is moving in both the direction. As Nifty is able to protect its previous swing low, but still looking at the overall scenario and looking at the structure for near term to short term, it shows that there is a weakness, and whatever pullback which we are getting in indices are attracting more supply pressure at higher levels. So until Nifty not able to take out 25,200 250 zone, trend is likely to exhibit on the bearish side, and whatever pullback we will get will be sold off. So sell on rise is the strategy for indices. But yes, as we are on expiry day and a lot of stock specific action is taking place. So some of the space from the metal, PSU banking basket, and some of the stocks from the cement are also showing sign of strength. So here one can focus on even some IT stocks are also showing sign of buying interest. So very stock specific action is happening in the market. So I think one should be selective in terms of stock for trading point of view. Bank Nifty is again, witnessing supply pressure at higher side. Some of the private bank has dragged the Bank Nifty also below 59,000 level now. So until Bank Nifty not able to regain above 59,000 mark, I think here also pressure would be there. On the downside, 58,500, 400 is the crucial zone. If he breaks below those level, then we could see more unwinding trade in Bank Nifty also. So Bank Nifty is also at very crucial level at this juncture. Some of the stock ideas where we are focusing at this juncture is from PSU banking basket. Bank of India is looking promising. On a weekly chart, there is a breakout and sustained uptrend. If we analyze on the daily, weekly time frame, stock is moving in upsloping channel. So I think here we could see more traction on the higher side. 168, 170, we are projecting target for Bank of India. So one can buy with stop loss of 157. And another stock where we are focusing on the long side, that is Oil India. Here also, if we look at after a brief consolidation, there is a fresh buying action we could see in this counter. And looking at the chart, we believe that 460 would be the next target. On the downside, 440 needs to keep as a stop loss.
All right. All right, Rajesh, thanks very much for that. Thanks very much for joining in with your ideas. We have to slip into a short break. Up next, our big story will come up on the banking sector performance, so stay tuned for that.
Welcome back. On your screens will be the footage coming in from Prime Minister Modi and the EU President. We have Ursula von der Leyen, who was obviously also the chief guest at the Republic Day Parade yesterday. And this on the back of a historic trade deal signed between India and EU, which was there in the works for many years. After 2 decades of on-off negotiations, the deal will pave the way for India to open up its vast market and the world's largest free trade agreement with India and the 27-nation EU. There you have it. Those pictures tell you that it has been successful. And also a lot of the analysts say that, this is in many manners a lot more landmark than the India-US deal as well, because the trade that India as a country does with the 27th bloc of the European Union is a lot more than what it does with one country, the US alone. So at a time when we are speaking about India-US trade deal and the uncertainty around that, this definitely comes as a big positive, and those pictures suggest that as well. But speaking about another big positive, it's the banking space. The Nifty bank is holding up with a gain of almost 0.5%, 310 points. And now we've had all the top private banks reported their earnings in the third quarter so far. So how do these stack up against each other? And in general, what does this mean for the sector? That's our big story today. And Gaurav joins in with all the data. Gaurav.
Well, yes, if you look at the top 5 banks data, we saw the banks and shareholders actually shaking and breaking the market with the data that we have got from the third quarter results. So first, let's talk about advances and deposits. If you look at the growth, we have got Axis Bank and Kotak Mahindra Bank actually reporting good set of numbers. In fact, what stood out well for Axis Bank is that for the last 5 quarters, we have seen the growth was slow. And at the same time, in this quarter, this is one of the banks where deposit growth was higher than the loan book growth. Other than that, HDFC also reported good set of numbers, but then comes another point, which is LDR. If you look at the chart, LDR ratio for HDFC Bank is the highest among peers right now. And at the same time, another concern here is that the LCR ratio for HDFC is also a bit lower. And that is the reason why, despite good set of numbers in terms of advances and deposits growth, we saw market actually punishing HDFC Bank as the stock did not do well despite giving good numbers. Let's also focus on the net interest margins part now. If you look at net interest margins, overall, more or less, they came in line with the street's expectation, barring HDFC Bank, where we saw 8 basis points of increase on a sequential basis, which was actually a bit positive. And on the flip side, we saw Kotak Mahindra Bank. This weekend itself, the bank actually reported numbers. They reported flat numbers, but the street was expecting a bit of an increase. Let's not forget about Axis Bank, although there was a decline, but it was in line with the street's expectation. Now, coming to the asset quality side, there also we saw the performance, which was actually in line with the street's expectation, but here we saw ICICI Bank as an exception for the first time in this quarter, and the reason being that there was increased provision worth 1,280 crores, and this was because of the agri PSL portfolio, and regulators asked them to do so, and that is the reason why the slippages, the credit cost actually increased, but at the same time, slippages, they remained contained for all the banks. Lastly, given all these parameters, let's also not forget about the ROAs. Now, if you look at the ROA parameter, HDFC Bank actually reported good set of numbers, but at the same time, Axis Bank was the key outperformer because we saw around 26 basis point of improvement in the ROAs, and this was because of the core performance that we have seen in Axis Bank. While on the other hand, Kotak Mahindra Bank also reported 1.9% ROAs. If you look at the number, it is actually higher, except for the HDFC Bank, but there is another concern, which is the higher valuation for the bank, and that is the reason, despite delivering 1.9% ROAs, which is again lower than their overall average that we have seen for the bank so far, that is the reason, despite giving good performance, we saw some underperformance from the stock. So all in all, to conclude, we saw movers and shakers across the segment, and with 5 private sector banks, it is clear that at least in terms of numbers. Axis Bank currently gaining in trade, given that a good set of numbers that they have delivered. And on the flip side, the Kotak Mahindra Bank actually delivering poor set of numbers, at least in terms of the expectations that we have seen from the market.
All right, Gaurav, thanks very much for shining a light on the big banks that have reported numbers in the private banking space so far. But the clear takeaway so far has been the deposit growth lagging loans by a wide margin, because of which you've seen the LDR ratio touching all-time highs. So that has consistently been a concern across banks, with a few exceptions here and there, that loan growth has picked up, but deposit growth has not kept pace because of the ongoing shift away from bank deposits into other avenues chasing higher yields. The second concern has been that while loan growth has picked up, for large banks, they're stuck in the mid to low teens kind of a growth year on year. Whether that picks up meaningfully is something we'll have to see. With the fiscal space largely used up, RBI rates has also come down. So what happens from here on is something we'll have to see. The second, the third interesting thing is, despite the rate cuts that we've seen, and thanks to some of the help coming in from the CRR cuts that happened in the quarter as well, banks have been able to widely defend their net interest margins, which has come as a positive surprise. The lag deposit repricing is also helping. And, the big takeaway also has been asset quality. In the last few quarters, we've seen concerns, whether that was on the MFI front, the MSME front, the unsecured, book not really showing an improving trend. That seems to largely be behind. A couple of banks still indicating it may take a quarter or two for stress levels in MSMEs and MFIs to come down. But largely, asset quality improving, NPA ratios at decadal lows is a positive overall. Now the big numbers remain from the likes of SBI that we'll hear during the course of the next week. So that's something the markets will take more cues from. For now, we'll slip into a short break. Up next, we'll get you more on the markets and get you a check of other parameters when we return.
Well, it's volatile moves on the market. For moments ago, the Nifty was actually up 100 points, closing in on that 25,150 mark and now settling with a 70-point gain. Around 25,120 is where we are. It's been no less than a roller coaster. The intraday chart tells you that. And it's the Nifty Bank which is actually leading that engine of the roller coaster, because moments ago we had the Nifty Bank which was up 320 points. Now it's fallen a smidge, up around 250 points, still outperforming. Amidst all of this, the mid-cap index is doing what it is. It's absolutely flat, with the advanced decline still not having made its mind, with almost an equal number of stocks advancing for the number of stocks which are declining. Those crisscross lines come up for you now, just about crossing 1,500 each for the advances and decliners on the broader markets. There you have it. Again, it's an indecisive, extremely volatile, fairly choppy market. But right now, the bulls are on the way up. India has concluded its free trade agreement talks with the EU, as you saw the visuals coming in, and the announcement is expected later this afternoon. Abhimanyu joins in with the latest on those visuals, the developments, and what's expected.
It has already been dubbed as the mother of all deals between India and its largest trading partner, the European Union, for which talks have already been concluded and a formal announcement is likely to be made later in the day today. Of course, both the sides are looking at significant gains as far as increasing bilateral trade is concerned. India is looking to increase its exports of labor-intensive products like marine products, textiles, and leather. On the other hand, the European Union is looking at India as a potential big market for its EVs, for its cars and automobiles, and also for its wines and spirits. It would be interesting to note how the issues of carbon tax and EU deforestation regulation are going to be discussed and addressed as part of a trade agreement in which talks have already been concluded, but the legal scrubbing of the documents would go on for the next few months. Over 20 chapters have been noted so far, which cover different subjects like sanitary rules, like intellectual property rights, and even sustainability for that matter. It remains to be seen how all pending issues are going to be addressed as part of the legal scrubbing and the formal ratification, which is likely to take place sometime around 2027 when the deal is likely to come into force. So all eyes, of course, would be on the significant gains which are being looked at for both the sides.
Thanks, Abhimanyu, for bringing us that update. Now, in an exclusive interview to CNBC-TV18, the EU Trade Commissioner Marco Sefcovic tells CNBC-TV18 that both India and European Commission are looking forward to signing the deal, but there are legalistic issues. He also added that by 2027, both the sides can see benefits from the trade agreement. Take a look.
I was very much encouraged by the ambition of Minister Goyal, who would like to ratify this agreement as soon as possible. And we will do our utmost to match this ambition, because, of course, being a little bit legalistic here, what will proceed once we get to the agreement. You have to do the legal scrubbing. In our case, we have to do the translation in 24 official languages and then, of course, proceed with all the procedures. But I think there is a huge interest on both sides once we agree to really offer the positive outcome of this agreement to our economic operators and wider public as soon as possible. So I hope that by the next year that we can actually benefit from this agreement.
So by 2027?
Yes.
All right. With that, let's address the exclusive. The bottom of your screen, a big story coming in. Axis Bank is evaluating the acquisition of a promoter stake in Credit Access Grameen. Remember, Axis Bank reported a good set of numbers. The stock up around 1%, 5.5%, the top Nifty gainer right now. But Credit Access Grameen was one of those big movers all of last week on the back of a stellar set of numbers coming in, backed by good management commentary as well. And as the news flashed at the bottom of your screen, there was a vertical spike on Credit Access as well. Closer to 22,000 crore market cap, promoters having a 66% stake. Could be a near $2 billion sale. Axis Bank is the front runner here. Yash brings us the story. Let's go across to Yash. Yash.
Well, absolutely. This could be a very big development brewing in the banking space. What we've been given to understand from our sources is that at this point of time, Axis Bank is at the stage of evaluating acquisition of the entire promoter stake when it comes to Credit Access Grameen. Once the evaluation at the team level, of course, goes and concludes, then, of course, it may also consider placing a bid for that entire 66% promoter stake in Credit Access Grameen. What we've been given to understand from our sources is that the promoters of Credit Access Grameen, have initiated the process to sell their entire 66% stake in the company. Investment bankers have been appointed for running this process of the entire promoter stake sale. What we've been given to understand from our sources is that there is one foreign investment bank and one Indian investment bank which have been given the mandate already to run the process of selling this entire 66% stake. As far as the value of the promoter stake itself is concerned, it is about 14,000 crore rupees, as you rightly said, market cap of about 22,000 crore rupees for Credit Access Grameen. CNBC-TV18 has written to all parties involved in this particular transaction, Credit Access Grameen as well as Axis Bank. We are yet to receive a reply from the entities, but just to understand the size of Credit Access Grameen, a branch network of about 2,222 branches, customer base of about 44 lakh customers, AUM of nearly about 26,000 crore rupees. So a large entity where the promoter is looking to sell its entire stake, and one of the largest private bank, Axis Bank, looking and evaluating the process of acquisition of this.
Right. Yash, just to understand this a little more, do you have any inkling on the kind of price that this deal is likely to happen at? I have discussions reached that stage. If and also the mode of funding for Axis Bank, because it's not a small deal.
Of course, it's a large transaction. It is still away from the point where the pricing for the transaction would be decided, because the team at this point of time at Axis Bank, according to our sources, is still evaluating this particular transaction. And if it reaches the point of Axis Bank actually placing a bid and going ahead with this transaction, then, as you said, it's a large transaction and there could be a possible fundraising at Axis Bank also to really support this transaction and go ahead.
It'll be very interesting there. And if it's the entire promoter stake, then perhaps the possibility of an open offer comes in as well. Ritu, a deal brewing in this space. Axis Bank looking to acquire, what, $2 billion worth promoter stake in Credit Access?
In fact, it was about 2 to 3 years back that Axis Bank had told us it is keenly eyeing an acquisition in the MFI space. At that time, of course, there were rumors about Spandana Spurti and so on, a deal that did not really materialize. But now, yeah, this will be a big acquisition to watch out for, and an interesting one at that in the MFI space where, credit growth is picking up for across the banks that you talk to. The pain that we'd seen last year seems to be improving. That's the space a lot of banks are bullish on. And Axis Bank looking to acquire promoter stake in Grameen. That'll be a big deal to watch out for. So, Yash, thanks very much for bringing us that update. We have to slip into a short break, but up next, we'll get you more on the markets just in a bit.
Holding around 25,100 for the Nifty right now and still in choppy terrain. But the one positive of the last few minutes has been Reliance. That stock's recovered from the lows. Let's see where that goes. With that, we'll wrap up on this edition of Trading Hour with Ritu, me and the entire team. Thank you so much for watching. Stay tuned. Halftime report comes up next.